Let's get some insights in the news shaping the markets. For that, we welcome in Joe Brusuelas is with us, Chief Economist at RSM. Good morning.
Good morning.
How are you?
Very good. What a day.
So let's talk about 272,000 jobs. Unemployment rate edges up to 4%. What did you make of it?
All right, so this is one of those jobs reports where good news is good news, right? We've got a remarkably resilient labor market. Labor market demand has just continued to increase at a very strong and sustained pace. My main takeaway is that most of the jobs, the hiring was clustered in higher paying categories, which was why we saw the 4% year ago increase in nominal wages. If we use the PC as the baseline, that translates into a 1.3% inflation adjusted increase in wages over the past year. That means Americans' living standards are rising despite the inflation shock that we've experienced over the past 3 years. This is really textbook on how you get out of a situation where you have that type of inflation shock.
So with the hourly earnings, I'm seeing 0.4% versus the estimate of 0.3%. Year over year is 4.1%. What did you think of that? Because that's something the Fed's watching, right?
Yeah, so that completely just removes any hopes of a July rate cut off the table. Before I came in, I took a look at the market probabilities. September's now just a coin flip, 50%. Now, my baseline forecast for a while now, as you know, Nicole, has been September, a 25 basis cut then, and a 25 point basis cut in December. So that's now clearly at risk because the U.S. economy, the labor market, just continues to outperform.
Right, and this 4% unemployment, the estimate was for 3.9%.
Yeah.
What I think about what's interesting is this resiliency, because up till today's jobs report, people were starting to bet more and more on the cuts. When they take this in now, let's talk more about the cuts, because up to this point, you had the last week of data sort of screamed the Fed will cut, right? Now what?
Well, my sense is that the economy is going to cool. Right, it's been 2.5 years since they began hiking rates, and you're beginning to see it show up, most noticeably in demand for durable goods, which has been weak over the past 3 months. And look, the takeaway is, well, if your wages are rising, you can buy things, but if you need to buy things on credit, those rates remain elevated, and that's going to continue to be a drag on demand for automobiles, for homes, and other durables meant to last more than a couple years.
What else have you been watching as far as the big picture? You've already seen the cuts from ECB and Bank of Canada and the like. What else is in your big picture and your daily thoughts?
Well, what I like to look at is financial markets to start with, so I can see if there were risks developing. One of my big picture takeaways is at the turn of the year when we talked about what we thought was going to be happening this year, what the risks were. One of the risks was commercial real estate. The other is the looming maturity wall of debt. That's the debt that was issued in 2020 at the low. That's going to roll over next year. So, Nicole, one of the remarkable things is that the American capital markets have just absorbed the issues in commercial real estate. That's being rolled. It's not the risk I would have thought it would be at the beginning of the year. So that's one of the big takeaways. I'm just not seeing the risk metrics, the widening spreads that would suggest A, we're going to have a problem, B, there's a risk of a recession, or C, we're going to have to hike rates. It's just not really happening.
When we see where the job gains are, healthcare, government, leisure and hospitality, some of those have been somewhat consistent. I mean, certainly, leisure and hospitality. What do you think of where the jobs are? All
right, so 204,000 of 272,000 were in private service providing. And you saw professional business services, 33,000, very strong. 84 of the 86,000, in the healthcare hospitality sector, 84,000 was in healthcare. Those are very good jobs that are being generated. What's interesting is that in the data, you can see the labor force participation rate of those 55 and older really has moved down. I mean, it's dropped significantly because the boomers are exiting, right?
Right.
Our economy, as we go forward over the next 10 years, is going to be defined by healthcare jobs as we tend to the needs of the elderly, right? So this is just going to be part of the scene, I think. It's It's just something that we'll all get used to.
We've heard from a lot of the retailers, and what we did see from the retailers is some are doing well, some are not. Consumers are picking and choosing where they spend money. So they're still spending, but just a little tighter or
less,
differently.
that's right,
Right? But retail did see an addition, I think, of 13,000 jobs or something.
They did.
What did you make of that? It'd be one thing if it were Christmas time, but what did you think of that?
Well, I think that consumer demand is going to cool. And it settles in right around 2%.
Right.
That's a nice, we all win range. So it was comforting to see demand for retail jobs rise, right? We're now moving into the part of the summer where we're going to be looking at hospitality as the next big job category to see if demand is really there. If that disposable income growth is then taken and used, and people actually go on vacation and spend money rather than do staycations, right?
I think a lot about housing because while, the inventory has picked up, there's more inventory now, but the prices come off the highs, but still, they're very expensive for housing. And even though mortgage rates have come down, they've sort of fluctuated. They went back up a little bit. Thought on housing?
Well, so housing demand is going to remain generationally strong. We simply don't build enough houses in this country, and that's got to do with local zoning and ordinances, right? But with the 30-year fixed rate around 7%, it's going to be difficult for some buyers to purchase a home, and purchase a first home in particular. This is why rates are, once they start to come down, you'll see it improve. But with the conforming rate at 7%, it's difficult. Really, where you see the action will be in the new home category, where the builders can create teasers over 3 years, and you can get a mortgage rate between 4.5% and 5.5% if you've got the credit and the capital to put down on a new home.
All right, Joe Brusuelas, RSM. Thank you so much. Great to see you, Joe. Thank you.